Welcome to a new video by Let Your Money Grow. In this video we are going to talk about volatility. Let's start with the question, what is volatility? To get a feel for it, let's look at the following chart. You see the S&P 500 and the Boeing stock. Take your time and look closely at the chart. You see that Boeing fluctuates more than the S&P 500. It has higher price swings. In this case, we would say that Boeing has a higher volatility than the S&P 500. Let's look at another example. Merck versus Dow Jones. You immediately see that Merck's price swings are somewhat bigger than the price swings of the Dow Jones index, especially the spike. So it's pretty obvious to decide which financial asset is more volatile by inspecting the charts. However, in many cases we want to quantify this visual information to be able to compare different financial assets more effectively. And we want to point out that the term volatility is used most of the time in a non-deliberate way. In a wider sense, the term volatility is used to describe price swings in general. This is in contrast to its mathematical meaning, which is strictly defined, of course. Now we turn to the question, how to measure volatility. There are many ways to measure price swings. One method is to calculate the standard deviation of asset returns with respect to closing prices. Calculating the standard deviation will bring you somewhat closer to the mathematical meaning of the volatility. But you could also calculate the so-called average true range, which is a well-known technical indicator and is basically the end-day average of the true range of prices. The true range you calculate in a special way. There are also special volatility indices that try to capture the volatility of large indices like the VIX for the S&P 500, for example. Such indices try to measure volatility by the implicit volatility of certain options on the index. We will revisit implicit volatility a little bit later. One of the most important questions you ask is, how does volatility affect you? Of course, this depends largely on your trading style. Big price swings in short time can be positive or negative depending on your trading strategy. For short-term traders, big price swings, i.e. high volatility, is desirable since fast-moving stock prices offer trading opportunities. For longer-term traders, investors, a high volatility is not necessarily good because wild price swings can trigger stop losses and kick you out of your position. If you have seen our video about drawdowns, you're familiar with the fact that large drawdowns are to be avoided at any cost since the recuperation in most cases costs too much time. Now, there's an intimate relationship between the volatility of your portfolio and the expected maximum drawdown. If your portfolio returns are normally distributed, which they usually are not exactly, we can calculate the expected maximum drawdown. The following chart shows the expected maximum drawdown that a portfolio can incur within 1 year depending on the volatility of the portfolio and its expected return. We see that there is an almost linear relationship between the volatility and the expected maximum drawdown. What may be surprising is that a threefold increase in the expected return does only have a small effect on the expected maximum drawdown. This means that even a high mean return does not prevent large drawdowns. However, a high mean return reduces significantly the time needed to recuperate from such a large drawdown. Keep in mind that we are looking at the expected maximum drawdown, which is a mean value. An individual maximum drawdown can be greater or smaller than that, of course. Let's look at what happens if we increase the time frame to 5 years for the same portfolio. We see that the relationship between the volatility of the portfolio and the expected maximum drawdown is not linear anymore. This is to be expected since the portfolio value has more time to deviate significantly than in 1 year. We see that now the expected maximum drawdown is around twice the volatility. What are other consequences of high volatility? Apart from drawdowns, another consequence is that stop losses of your positions are triggered more easily. If you are a longer-term investor, this may pose a problem. So it may make sense to integrate the volatility into your money management system. Refer, for example, to the turtle trading system. Also keep in mind that many derivatives depend on the volatility, like options. If volatility rises, they become more expensive, so that trading them becomes generally less attractive, i.e. profitable. You should also be aware of an interesting property of volatility, namely volatility clustering. To explain what volatility clustering is, let's first look at an actual example of the Dow Jones index and the absolute value of its returns. If we look closely at the returns, we see that periods of relatively large returns are followed by periods of relatively small returns. Obviously, periods of large returns are also periods with high volatility and vice versa. Now, volatility clustering refers to exactly this fact. Once volatility is high, it tends to stay high until it flattens out and periods of relatively low volatility follow. It is worth mentioning that periods of high volatility correspond to major reversal points of the Dow Jones, like here and here. This is also the case for many other indices or stocks. On the other hand, periods of low volatility often fall together with pronounced trends, like here. Finally, let's talk about applied volatility. In some cases, especially when talking about options, one comes across the term implied volatility. As in this video, most of the time when talking about volatility, one is actually referring to the historical volatility. It is called historical because it is calculated from past data. The term implied volatility is related to options and their pricing via the famous Black-Scholes formula. Of course, we will not delve into this formula in detail, but what we can say at this point is that the price of an option depends on 5 input parameters. These are the price of the underlying asset, for example stock, the strike, the time till the option matures, the interest rate, and the volatility of the underlying. So the volatility is an input parameter for the option price. However, since options are also traded, they themselves have a price that can and usually does differ from the theoretical price of the option. If we now plug in the market price of the option to the Black-Scholes formula and solve for the volatility, we obtain the implied volatility, since this is the volatility that the current market price of the option implies. So that was our introduction to complex volatility topic. We hope you enjoyed it and stay tuned for future videos.